Thank you, Chairwoman Maloney, Ranking Member Gilmore, and members of the committee. The Center for Responsible Lending is a nonprofit research group that works to prevent predatory lending and encourage responsible lending. As an affiliate of Self-Help, one of the nation's largest community development lenders, we have provided more than $4 billion of home financing to over 50,000 families. In doing so, we buy, sell, and finance loans in the secondary market. Prior to my present position with Center for Responsible Lending, I served as head of those secondary market operations. The secondary market, including both private companies and the GSEs, greatly influenced the home loans that American families receive. Historically, this has been a positive influence both in terms of price and the terms of the loans. More recently, however, the secondary market has contributed significantly to the present problems that we see in the mortgage market, and particularly the current subprime foreclosure crisis. We have widespread loans with built-in payment shocks, undocumented income, unreliable appraisals, and underwriting that not only fails to determine the borrower's ability to repay, but actually ensures the borrowers must continually refinance to keep up their payments, thereby deleting their home equity and often facing foreclosure. In my testimony today, I will address 3 points. How has the secondary market contributed to the present problems? What is its responsibility in reducing the number of families who will lose their homes in the next 24 months? And what is the secondary market's role in prospective efforts to avoid a repeat of the current situation? The secondary market encourages and discourages practices by its demand for loans. In recent years, this demand has been very high, with little regard for loan quality. This was based on the rapid increase in housing appreciation, which covered up an abandonment of many long-held fundamental lending principles and resulted in lending often on the home's value rather than the borrower's ability to repay the payments. In addition, the lack of accountability in the overall loan delivery system is commented on by Mr. Litton, where other major contributors, where mortgage brokers and other originators were paid and then gone at loan closing, so they had little concern about the quality or sustainability of the loan. I would urge you that one of the most important lessons, though, is that the secondary market will not correct the structures and incentives that have led to the current crisis. The secondary market measures risk and allocates that risk. It can structure and handle loans where 1 out of 5 borrowers lose their homes. It can protect investors even in those situations. What is needed is accountability in this market must be reestablished throughout the system, or will continue to produce the results we see today. As we sit here today, we looked at the securitizations for the first quarter of this year and found that over 40% of subprime loans in those securitizations still are no-doc loans. This far into the crisis, the system still is producing problem loans as we sit here today. Quickly, the secondary market must help borrowers facing rate resets. Over 6 million families will be at risk in the coming months. It must help them transition. First, for those borrowers who qualify for prime rate loans, which will be a significant number, they must be provided transition to those prime rate loans. Others should continue with their current loan payments without payment shock resets or new fees, and some will require modifications that reduce principal or interest. If voluntary participation is insufficient, regulatory or legislative measures may be required to make sure these efforts are successful. Going forward, as Congress looks to improve the mortgage system, 2 things are needed. First, there must be additional substantive protections for families for their largest but least protected transaction, their home mortgage. And second, there must be incentives for the secondary market and all of the market participants to see that those protections are followed. This requires appropriate assignee liability. First, it is important to make clear that by assignee liability, it does not mean that individual investors would be at risk, but rather that mortgage securities must be held responsible. Just like with a stock, there would be a firewall between the individual MBS investor and any claim against the company issuing the securities. Assignee liability is not a new concept in credit markets or even in the mortgage market. The FTC holder rule, truth in lending, and state predatory lending acts have shown that these provisions can encourage compliance without restricting credit. In summary, homeownership builds families, communities, and our economy. Conversely, large payment shocks and foreclosures stress and destroy these. In recent years, homeownership has been harmed, not aided by subprime lending, and the secondary market has contributed to this homeownership loss. Additional protections with accountability in our mortgage system are required so that home lending fully realizes its potential to sustain and build American families and communities. Thank you.
Thank you. And Ms. Kennedy, thank you.
Thank you for the opportunity to talk about this. I've been at this issue for so long. I wish I had a singing voice, because I really feel like we could break this into 3 songs, and I picked up a 4th one today from the discussion of Georgia. From the standpoint of communities, how long can this be going on? From the standpoint of legitimate lenders, looking for loans in all the wrong places. And from the standpoint, frankly, of the borrower staying alive. These are the songs that sort of sum up what we're about. And today I found a new one in the discussion, and that's the night that the lights went out in Georgia. I think we have to maintain a sense of humor about this, because otherwise I think we would go crazy. I have tremendous respect for your trying to solve this problem. Let me share with you what I know. NOL represents America's leaders in lending and investing in low and moderate income communities. About 200 organizations, 50 major banks, 50 of the blue chip nonprofit lenders. We have been struggling with this issue since 1999, when Gail Sigkata, the premier advocate for community reinvestment, sick, frail, close to death, made it to a NOL meeting to say, you have got to take this issue on. If not you, who? If not now, when? And she was talking about the Chicago experience. So we committed to be part of the solution. We convened the best and the brightest through all of 2000, including Mike's boss, from the lending industry, from government-sponsored enterprises, and on the best and the brightest. And we came up with a report that Senator Sarbanes was kind enough to call the roadmap. Mel Martinez was recent HUD appointee to the secretary's job. He came to share his own experiences as a Cuban emigre and as a county executive in Orange County, Florida, with predatory lending. And at the end of it, trying to be upbeat, he said, "Juntos podemos, together we can." And thanks to Senator Sarbanes' tremendous effort to have states' attorneys general and members of Congress understand this roadmap, he constantly reminded any audience he spoke to of the quote from the report that says, "If the sheriff's out of town, the bad guys are in charge." Well, lots happened between 2001 and 2005, and you know it well. Bipartisan efforts by this committee and others to address the issue. We spent quite a lot of time, frankly, on updating HMDA and HWEPA. We fell, all of us, I think, into a HUD Treasury predatory lending task force that made enormous strides in clarifying the issues, at least in 4 markets, including Atlanta. But despite all of this activity, not the least of which has been bank regulatory focus on this issue for the last 5 years, so that as of last year, less than 10% of subprime loans emanated from national banks, and the default rate on them is half of the national average. We come to this point and we say, how long can this be going on? How could this still have happened, be happening, and why? And frankly, I think it comes back to unintended consequences surrounding the absence of a sheriff in the secondary market. Mr. Watts spoke about the doughboy. I think of it more as whack-a-mole. You slap it down here, it moves over there. There's plenty of responsibility to go around, but let me suggest that the lack of GSE oversight and the Secondary Mortgage Market Enhancement Act unwittingly created this mess. Let me sum up. For the past several years, Fannie and Freddie's bestseller servicers, among them Ms. Maloney's constituents and many of yours, have been complaining to the GSEs that their refusal to help primary lenders meet the credit needs of their communities under the Community Reinvestment Act was causing these lenders to lose legitimate prime borrowers who walk down the street to subprime lenders who may be offering loans with abusive or predatory terms, and that Fannie and Freddie were financing those very competitors. Didn't sound logical, didn't sound right. We knew the GSEs had a fear of buying legitimate single-family loans. Not until the end of '06 and the focus on the portfolios of the GSEs, with OFEO cooperating with HUD to get to the bottom of what was in them, did we learn that the well-intentioned action of this committee in 1992 to ask GSEs to lead the industry by taking less of a return on affordable housing resulted in the GSEs chasing yield from subprime loans. They have been the principal financiers of mortgage-backed securities. And worse, they use these AAA-rated, presumably safe, risk-free AAA tranches for HUD affordable housing bills of credit. So, we used to say that everyone loses in foreclosures, but that's probably not true anymore. The investors holding the AAA-rated pieces hopefully will be okay, or all of us are in tremendous trouble. We've tried to keep a sense of humor about this. I presented to 150 OFEO employees who examined the GSEs bumper stickers, which I asked them to leave under the windshields of cars at Fannie Mae and Freddie Mac saying, "You're looking for loans in all the wrong places. Call now." And I brought copies for every member of the committee. Where are we now? Well, because Fannie Mae and Freddie Mac really are our nation's market.
The chair recognizes the gentlelady for 60 additional seconds.
The market has evolved by adapting to what the GSEs will buy. We need H.R. 1427. We need a serious regulator with tough enforcement authority. We need to look at the Secondary Mortgage Market Enhancement Act. Within months of enactment, financial engineers had figured out ways to turn off the safety valves that were intended in that legislation. We need a level playing field. Whack-a-mole, doughboy, whatever you want to call it, legitimate lenders are doing the right things, and they're losing market share. Freddie Mac estimated that 50% of all subprime loans are made to people who qualified for prime. Finally, we know what works. We have great nonprofits, and this is in report number 2 that I hope you'll access. On June 25th, we're announcing a national media campaign supported by lenders of organizations. Call HOPE, 1-800-number. This is a huge development where they will talk to certified counselors anonymously who will then, if they want them to, link them up with the right help. Lots to do. Together we can.
Thank you very